Welcome to the Efficient Quarterly Update. I'm joined today by one of our portfolio managers, Christiaan van Wyk, as we discuss the end of the first quarter for 2025. Christiaan, let's start by painting a picture of the financial landscape of 2025. How would you characterize the market environment that we're currently navigating, and what's your perspective on the next few quarters?
Okay, thanks Carl, thanks for having me today. First off, I think first quarter of 25, in one word, volatility. We've seen volatility in the financial markets. We've seen differential performance between different regions, which is good to see, I think. US has dominated the financial markets, especially in the equity space, over the last couple of years, with the rest of the world, emerging markets, Europe, kind of no one looking at them, or basically prices playing flat. We've seen a new president in the White House, once again, Donald Trump, Republican president. He came in with a very strong agenda, I think different to last time. He had a plan, he had people already in place, and I think we are starting to see the moves much quicker and much more meaningful than we did in his first term as president. But yeah, volatility all around. I think if we take a look at the financial markets, first of all, the US equity market lagging behind the rest of the world. Europe doing quite a bit better, emerging markets starting to look a lot better, obviously coming off a much lower valuation than the US. Coming into the 2025, basically everyone expected US to remain economically very strong. The US equity market, will be the only market that will ever give you good returns. That's kind of where investors were, a lot of investors. And as the quarter kind of progressed and everyone, started realizing that there are some, troubled waters ahead, tariffs, especially that's been the big, macroeconomic factor influencing the markets. That has placed some strain on the US equity markets. We saw them, correcting quite a bit. Institutional investors as well as retail investors repositioning to, like I said, Europe and emerging markets. For the quarters ahead, I think volatility will remain. As long as we have uncertainty in the global financial markets, stemming from especially tariffs. I think where tariffs at the end of the day will land, what actually will be implemented, and that's going to continue to bring uncertainty. Interest rates and inflation, that's obviously top of mind for a lot of investors and consumers as well. So all of those are still quite uncertain because we've got an uncertain policy, uncertain policy environment, and as long as that lasts, we'll see volatility in the financial markets.
Okay, it's interesting if we look at something like the S&P 500 with its particularly strong run in recent years, and now we've seen a significant dip. What do you think we see as the primary drivers behind this shift?
Yeah, so the primary drivers definitely geopolitical factors. So tariffs, that's been top of mind and top of all major news headlines. That's the only thing we read about is how Donald Trump is destroying the world with tariffs. And correct or not, I'm not sure, but that has been the biggest driver of the equity market volatility. And also, the Fed basically staying on the sidelines. The US Fed has been, they basically don't have a view on where economic growth is going, where unemployment is going. So they opted to keep interest rates steady. They're not cutting anymore. And a lot of investors look to the Fed for kind of guidance in terms of, where are we going? What type of macroeconomic landscape are we heading into? And the Fed is also basically taking a wait and see approach because I just think the uncertainty is so high, stemming from especially Donald Trump.
Okay. If we turn our attention now to something like corporate earnings, the final quarter of 2024 results basically just come in. What were the key takeaways?
I think the key takeaways is fourth quarter earnings of last year were still strong. So most companies still managed to either achieve or exceed market expectations. And the bar was still relatively high. I think the big problem in terms of earnings specifically came in with guidance on the future for the rest of the year. So management is obviously trying to make sense of what's happening in the world, what's going on. Are they going to implement what percentage of tariffs? Because we know global supply chains are extremely interlinked. It's not as easy to say you're manufacturing all your goods in the US and you're selling all your goods only to US consumers.
Not that simple.
We live in a global economy, and I think management have increasingly been more uncertain about guidance and have actually lowered their earnings. The general earnings expectation has been lowered by 3 or 4% since the start of the year. So that has been. I think that's the key takeaway from the latest earnings reports, is that management of these companies, global companies, are also a bit uncertain where we're going, where economic growth is coming in, and that's why they kind of lowered their earnings expectations or where they think their earnings will land, to kind of create a little bit of a buffer in the markets. And obviously markets don't like that, because they price in future earnings, and if you lower those future earnings, it's not good for the companies.
Yes, no, definitely. So let's shift gears now to the bond markets, specifically looking at the developed economies. How have bonds been performing so far this year?
Yeah, so I mean, US Treasuries have held up pretty well. Obviously in volatile times, your bond market, especially on the shorter end of the duration curve, they tend to be seen as a kind of a safe haven asset, where investors park their money to get away from the market volatility. So they fared fairly well, but the European bonds have actually not done as well, because we've seen a lot of fiscal spending, especially from countries like Germany. Trump has repeatedly said they're not paying their fair share, and they're withdrawing a lot of those funding. So funding gap has to come from somewhere, and that's going to come from the fiscal accounts. So the European economies have been stimulating, and also raising their economic growth projections from this ECB because of this fiscal spending. And unfortunately, at the end of the day, someone has to pay for it. So if you have to pay for it, that means you have to issue more bonds, you have to go into further debt, and that unfortunately has resulted in lower or worse bond performance from the Europeans.
Yes.
That's
okay. So if we move across now, I think we sufficiently covered Europe to global, and you give us some insights on the Asian equity markets. How have they fared in this first quarter?
Yeah, it's a change of what we've seen in the previous few years. India used to be the star child. China was once again uninvestable. We've heard it from market participants 2 or 3 times already that China is uninvestable, and then a year or two later, it once again is a great investment destination. So we've seen quite a discrepancy in performance. India struggling a little bit. China doing exceptionally well. So China is obviously one of the big emerging market or big Asian markets, especially of equities. The government has come in with a lot of stimulatory measures, and also backed off quite a little bit on the companies, the private or the stock markets, giving them more freedom, not persecuting CEOs.
That does help.
It helps a little bit with confidence. And then obviously the Chinese companies like Alibaba, they've come out with competing AI models. So everyone thought up until DeepSeek was released that the Americans are the only ones that can do AI, and it will only be that way for the next 10 years. And obviously at a fraction of the price with similar capabilities, DeepSeek came out, Alibaba brought out their own AI model. Now the world's starting to pay a little bit of attention. Maybe there is something at the end of the day behind Chinese stocks and Chinese companies. And I mean, a lot of people have been saying it. We've been saying it for some time. It's trading at extremely cheap valuations, and we're starting to see that value unlock as investors start seeking other destinations.
Yes, no, definitely. So in a year like 2025, investors rely heavily on diversification. How effective has the strategy been, and what kind of benefits are there actually for the investors? What have they experienced?
Yeah, I mean, diversification once again just showed how important it is in the client's portfolio. Just in the small space of the first quarter, you've seen equity market volatility. US equities specifically, going into correction mode, and then bonds. If you had a kind of a diversified portfolio from asset class perspective, so bonds, equities, and cash, a lot of the volatility would have been buffered if you held US bonds as well. Regionally, I mean, if you look at, for instance, an equity or bond, whichever asset class, throughout the world, diversification is once again also important, because the US equity market will not be the only market to ever give you any returns. Like we've seen in the first quarter, there's been discrepancies in equity markets. Same thing with the bond markets, as we also discussed. So not to only invest in a specific country, diversify across countries, diversify across asset classes, and that manages the volatility of your portfolio and keeps clients invested at the end of the day. The more you concentrate your portfolio, the higher your potential return becomes, because you are taking big bets, and if it works out, it works out great. If it doesn't work out, then everyone's angry at everyone. But I think diversification, once again, and especially in uncertain times like these, is very important, and that's how we structure our portfolios here at the Efficient Group.
Okay, thank you, Christiaan. I think that summarizes everything very nicely. Until the next quarter, thank you.
Thank you.